This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session, we saw how it was that if an individual had adjusted net income, as we called it, in excess of £100,000, it would lead to a reduction in their personal allowance. These are high income people that we're talking about. Well, in this next section, the transferable amount of the personal allowance, we're going to the other end of the spectrum in terms of the level of income that an individual has. We know that the personal allowance is £11,850. That's a tax-free income figure for the 2018-19 tax year. Think about the personal allowances, again an old adage here, you either use it or you lose it. So if, for example, in a tax year, I've only got £6,000 worth of income, then I've wasted £5,850 worth of the personal allowance. It is unused. That £6,000 is more than covered by the £11,850. But that unused personal allowance does me no good. I can't carry it forward to the future. Next year I get another personal allowance set at whatever level the Chancellor of the Exchequer decides to use for that tax year. So we use it or we lose it. So what we have as a situation is if we're dealing with spouses or civil partners, again, basically in terms of personal tax, wherever we talk about spouses, we talk about civil partners as well. It's one and the same in terms of taxation implications. But if you have one spouse who has, say, income of £6,000 and another spouse with income of £30,000, then clearly the one spouse with £6,000 is wasting a significant amount of their personal allowance and it's not benefiting the other spouse. Now, wouldn't it be nice if some part of the personal allowance of the individual with the low level of income, the one who is not using all of their personal allowance, if that could be transferred across to the other spouse to save tax for them? And that's the basis of what we see here, the transferable amount of the personal allowance. Of course, the way that it works might be slightly different to the idea that you might have at the moment. Sadly, what we cannot do is simply transfer across any unused personal allowance. There is a cap on how much can be transferred. It's basically set at a level of some 10% of the personal allowance, rounded up to the nearest £10, as you'll see here. But it's a figure that's going to be given to you. The transferable amount is a set figure. It's not just any unused personal allowance. And it's not any possible situation in which you can transfer it either, such as we'll see in the notes. But hopefully you got the concept. It would be right and proper to allow some use of an unused personal allowance from one spouse who is not a taxpayer to transfer to the other spouse who is the taxpayer. That's a nice little generosity there on the part of HMRC. So how does it work? Right, looking at the note. An election here may be made to transfer a fixed amount of the personal allowance to, as we've said, a spouse or civil partner. The amount is set at £1,190 for our 2018-19 tax year. Again, this amount, the amount of the transferable personal allowance, will be given in the tax rates and allowances provided in the exam. Now, hopefully, you've got your tax rates and allowances page with you, as I said earlier on in this chapter, because we're going to use it quite extensively. You'll see there that transferable amount at £1,190. What we said, though, is that there are restrictions about who can transfer to whom in terms of the level of taxpayer that they are. We can't simply transfer the unused amount. That is restricted to £1,190. Now, the election is only available when both taxpayers are either just basic rate taxpayers or, and rather more likely the situation, is the election is only likely to be made when one spouse is a non-taxpayer, they've got an unused personal allowance, and has therefore an amount of unused PA that would otherwise be wasted, and the other spouse is only a basic rate taxpayer. So this election is only available where we've got basic rate taxpayers at the highest level. we can't go above basic rate. You cannot transfer this amount from someone who is a non-taxpayer to someone who is a higher rate taxpayer. It's only possible to a basic rate taxpayer. Now, someone transferring an unused PA from one basic rate taxpayer to another, well, although there are weird and wonderful circumstances where there might be some benefit, it's not going to, in most practical purposes, be the issue. The issue is where we started, one of the spouses has got an unused personal allowance, and therefore, rather than wasting it all, the £1,190 can be transferred across. But how is it transferred? It doesn't just increase the personal allowance of the transferee spouse. Instead, what happens is we get it as a reducer. Now, this little bit here is talking about just the election and the administration of the system. I'll come back to that in a moment. But the relief is not given as an increase in the personal allowance of the transferee spouse, but instead as a tax credit to be deducted in deriving the tax liability of the transferee taxpayer, and is given at the basic rate of tax of 20%. So we do not increase the personal allowance of the transferee spouse. We do their normal income tax computation. They'll be a basic rate taxpayer. Their income, whatever its makeup, is going to be taxed at the relevant rates there, given whether it's non-savings, savings, or, of course, dividend income. We will calculate that figure of tax and then reduce that tax by 20% of £1,190. And that, of course, gives us a figure there of £238. So the transferee spouse gets a reduction in their tax liability of £238. Now that's good news for the spouses. The unused personal allowance, however much of it there may have been, was going to be wasted if the individual has a low level of income and has unused personal allowance. In this way, some £238 worth of tax credit can be transferred from that spouse who had again an otherwise unused personal allowance and given to the spouse who was otherwise a basic rate taxpayer. Again, it's the only likely situation you'll see this in from a non-taxpayer spouse to a basic rate taxpayer spouse. Cannot go to a higher rate or additional rate, only to a basic rate taxpayer spouse. Now, the admin behind this is seen here. The election must be made within, well, you've got plenty of time, 4 years from the end of the tax year to which it should apply. So it can be done here on a retrospective basis. Once we know the exact amount of income and therefore the exact amount of unused personal allowance to see whether the transfer again is worthwhile, then you can make that call. But if you have a situation where someone is, again, not just on a one-off basis having a low level of income, but consistently having a low level of income, then what we can do is to avoid having to make elections for every year, we have this situation. If the election is made within the tax year concerned, so sometime within the 18-19 tax year, before the 5th of April 19 for that tax year, then that election will remain in force for future years until either it's withdrawn or the conditions are not met. For example, one of the taxpayers, the transferee, becomes a higher rate taxpayer, then it would not be available. So again, sensible bit of admin there. As we said, this amount can only reduce the tax liability, £238 reduction in that tax liability, but it can only reduce it, it can't create a repayment. So if the transferee spouse is not much of a taxpayer themselves, and they only have a tax figure, what would otherwise be a tax liability of £200, then we can't deduct £238 and get a £38 repayment. It will just reduce the 200 to zero there. And we've got that situation here witnessed in terms of example 11, where we've got, I wonder who this could be, David and Victoria here are married. And in 2019, David, believe it or not, has a trading income assessment of £8,000. Clearly, therefore, unused personal allowance, £11,850 the personal allowance, so £3,850 worth of personal allowance is being unused. Whereas Victoria had a salary of £30,500, so at 30,500, well within the basic rate band limit in relation to taxable income. Remember, the taxable income is after deducting the personal allowance there. So this is the classic situation where we're going to see a transfer. So David, therefore, has his trading income assessment of £8,000. Therefore, if he transfers the £1,190 of his personal allowance, he'll still be left with 90% of that personal allowance, which is more than enough to still cover his £8,000 of income. So he was a non-taxpayer before the election, he's still a non-taxpayer after the election. It hasn't cost David anything to give up that £1,190 worth of personal allowance. Victoria, she's got her salary figure of £30,500. She doesn't get an increase in her personal allowance. She still deducts her own £11,850. The income was a salary. Remember, that is non-savings. So the taxable income, £30,500 minus £11,850, will be taxed at 20%, the basic rate of tax for non-savings income, falling, of course, within the basic rate band. But from that tax figure, something she wouldn't otherwise have had as a reduction, there is this tax reducer of £238. That's a welcome little payback, as it were, from HMRC to the married couple, reducing her tax by £238. Now, obviously, what you've got to do here is to calculate the amount of liabilities for each of the two taxpayers, and there's just a little test on stating the date by which the election should be made, just following, of course, the information there. So I'd like you to pause at this particular point, do the calculations, check out the answer to example 11 in the back of the notes there, and then come back to me. And hopefully you're back now. And what we have next to deal with, if that all went well on David and Victoria, I trust it did, deductions from total income. Now then, if I remind you of what the pro forma income tax computation looked like, let's just go back to that pro forma computation. We'll go back on page 5 of your notes, something which I hope that by now is again like the proverbial old friend to you. You could indeed sit with a blank piece of paper and draft out that computation, getting the income in the order of earned, then unearned, considering all such types of income, knowing without dealing with the details of trading profit, but on the other bases of assessment, we assess actual amounts received and how to analyse non-savings, savings and dividend. And that then brings us down to total income, from which this is where the deductions from total income, this note that we see here, deductions from total income, come in. And we basically got two types: qualifying interest and certain trading loss reliefs. More of that in a moment. So back to your pro forma. There you go. Qualifying interest. And here, rather than saying certain, it says other trading loss reliefs. The reason being, we didn't discuss this at the time of introducing this computation to you, but up here, as well as seeing these other trading loss reliefs being deducted from total income, there's another trading loss, which is any brought forward trading loss. So an unincorporated trader who has their own business, a self-employed individual, previously in an earlier year, maybe the previous year, made a loss and was not able to use all of the loss in those earlier years. And therefore, they were left with, they couldn't use it by the end of the year of the loss itself, they carried it forward. And that trading loss relief, when brought forward, will then automatically go against any future trading profit of the same trade. So a brought forward loss goes against the trading profit of the self-employed trader. The other loss reliefs, which, don't worry, chapter 7, we've got a complete chapter dealing with loss reliefs, will tell us about the nature of them. But the other trading loss reliefs are down here. Now, those other trading loss reliefs basically allow you to use the loss earlier rather than merely having to carry it forward to the future. what we'll discover in Chapter 7 is that we might be able to use a loss in the tax year in which the loss was suffered, or maybe carry it back to an earlier tax year or years, getting therefore a more immediate use of that loss rather than being simply compelled to carry it forward. Now we'll deal with those loss reliefs. Don't worry, we'll be dealing with them when we get to Chapter 7. But before we get to Chapter 7, just before you join us on that lecture, I want you to go back and look at this pro forma. And just remind yourself of what I've just said, that for an individual, if they have a trading loss brought forward, that's where it goes directly deducted from the trading profit. It's not deducted from any other income of this tax year. But if we were to have made a loss in this year, or indeed in the following year, that loss could have been relieved either again in the current year, 1819, or if we made a loss in 1920, it could be brought back into 1819. So any current year or carry back claim goes against total income. Just remind yourself of that before we start Chapter 7. You'll find Chapter 7 a whole lot easier as a result therefore. Okay, so let's see what we need to know about these things. In terms of qualifying interest to begin with, it's basically to do with if you borrow money, obviously you pay interest thereon, but most of the reasons why people might borrow money do not attract tax relief in relation to the interest they pay on those borrowings. Why would I borrow money? To buy a house, to buy a car, to go on holiday? None of these things achieve tax relief. They're very specifically prescribed loans that will allow the interest paid thereon to be an allowable deduction. And they're basically to do with business or employment. So, on a loan here to purchase an interest in a partnership, or a contribution to the partnership of capital, or indeed a loan to a partnership, you are lending, putting money into a business. On a loan to purchase plant or machinery used by the business or by a partner. An individual, therefore, loans money to allow them to buy plant and machinery for use within their business. On a loan, again to purchase plant and machinery, this time by an employee, if used in the performance of their duties of employment. Now, again, you would think, wouldn't you, that if an employee required certain plant and machinery to do their job, to perform their duties, that the employer would actually be buying those particular items of plant and machinery for them. It wouldn't be for the employee to buy them themselves. Again, just in case that were the situation, well, we've got a little bit of salvation for the employee. The interest they pay on the loan, that would attract tax relief. Or a term that you won't have to worry about, a loan to purchase an interest in a close company. Again, close companies are not within our syllabus. They await you at advanced taxation, again at the professional stage. So that's around the corner for you if you choose to go on and do advanced taxation, of course, there. Again, all you've got to do is recognise it as a term. In terms of reality, what are close companies? Basically, any owner-managed company is a close company. Any owner-managed company. But again, there's a more precise definition that you'll learn later on in advanced taxation, should you choose to go down that particular option route. Okay, the note that we said about trading loss reliefs there, these reliefs are deducted from total income in deriving net income, and as with the deduction of the personal allowance from net income, remember these deductions, as with loan interest as well, these deductions are deducted firstly from non-savings income, then savings income, and finally, if necessary, dividend income. Again, the reason why we laid those columns out in the way we did, from left to right across the page there, non-savings, savings, and dividend income. Again, whether it's a personal allowance or these deductions from total income, they will go against the income in that order. Now, what we have here is a simple little example, so I'm not going to work it for you. You're going to work this for yourself. But let's just look at what we've got to do here. And it's not tricky. Kathy has a trading profit of £50,000 assessed for the 18-19 tax year and paid £1,000 interest on a loan to purchase plant and machinery used in the business of her partnership. Again, up there on a loan to purchase plant and machinery used in the business by a partner there. So there's only one source of income. There is just that one interest payment there. You've got to calculate Kathy's income tax liability. Again, very simple. One source of non-saving income. There is no other income. So the non-savings, the trading profit income is your total income. And from that total income, we can deduct that £1,000 interest to bring you down to net income. From the net income, you deduct your personal allowance. There is only one type of income here, non-savings, but it would be non-savings anyway that you firstly deduct such deductions from. You calculate the taxable income and you calculate the tax thereon. That, therefore, shouldn't be a major problem for you. So again, I'd like you to pause at this particular point in time, just pause this particular lecture and come back to me after you finish that exercise. Okay, well, hopefully no problems there with example 12. Again, those qualifying loan interest payments, or once we've dealt with chapter 7 anyway, those trading loss reliefs, simply reducing total income in the same way as the personal allowance reduces net income down to taxable income, and that is firstly from non-savings income, followed by savings, followed by dividend income. Well, we now come here in section 6 to a most important area in terms of our studies and our calculation of the income tax liability. We're looking at payments being made to charity under what is a tax efficiency scheme, hence our involvement now, called the gift aid system, and also when an individual makes personal pension contributions. Again, pension schemes, of course, set up so that individuals through their working life can pay into them so that when they retire, they'll be able to receive a hopefully reasonable pension to keep them going in the way that they would wish to be kept going for the rest of their days, indeed, there. Now, we've seen reference to these items already. I wonder if you remember where that was. That was, in fact, back in section 4, when dealing with the personal allowance. And to be very specific, dealing with a restriction in that personal allowance. So we've got this note here. See section 4, not in fact on page 19. I think that's page 9 that should be. So again, hopefully in the version that you are looking at by the time you listen to this lecture, that will already have been adjusted. But page 9, that both the gross gift aid payments, and also what are gross personal pension contributions are deducted in arriving, there's the item, adjusted net income. The adjusted net income of the taxpayer. Remember what we did with that? We compared that to 100,000, the income limit. If adjusted net income exceeded £100,000, we would get a reduction in the personal allowance. Once we'd reached adjusted net income of 123,700, we ended up with no personal allowance at all there. So we've seen reference to them, but now we need to find out rather more about what these items are and the further significance it's going to have in terms of the calculation of our income tax liability. Let's just go back to the start of this little note here. And it says, firstly, that the gift aid system is a tax-efficient way by which to give money to charity and is available to individual taxpayers. So all of us as individuals. That means it's not available to companies. Companies have got their own way by which they get tax relief in relation to the donations that they pay. Here, though, for the individual. Now then, if I choose to make a donation to a charity, I take money out of my pocket, money out of my bank account, I transfer to the charity. That is coming out of, shall we call it, my net disposable income, i.e. after tax has been deducted. I had a salary, I paid tax on that salary, I received the net pay, and out of that net pay, I then choose voluntarily to make a donation to my favourite charity. Right. What happens is, through the gift aid scheme, is that everyone who is at least a basic rate taxpayer, when they make, say, a contribution of £80, a number I do not take at random, you might think quite a high number, but it's an easy round number. If I make a contribution of £80 out of what is my net income into my favourite charity, under this scheme, the gift aid system, the gift aid scheme here, then what the charity can do is not just take my £80 that I gave to them, but I, as a basic rate taxpayer, would have suffered on that £80 net as a basic rate taxpayer 20% tax. So I had an income figure of £100 from which HMRC at basic rate took 20%. And it left me with £80 net cash, net disposable income in my pocket there. And I've given that to my favourite charity. Well, what happens if I choose to do that? Under the gift aid scheme, presumption I must at least be a basic rate taxpayer. Then what the charity can do is go along to HMRC and say, this particular individual has given us £80, they are a basic rate taxpayer, they had suffered £20 income tax that they paid to you on their £100 of income, from which the £80 of net income derived, give us that £20. And HMRC will take the £20 of tax that they deducted from me on my £100 worth of income and pay that also over to the charity. So from me giving £80 out of my net income to the charity ends up not just with the £80, but also with the £20 tax coming back from HMRC. They end up with £100. So for the charity, it's great news. They get £100 from what was an actual gift made by me of £80. And for me, I'm gaining benefit because if I wanted my favourite charity to have £100, I don't have to give them £100. I need only make this gift aid payment of £80 there. So anyone who is at least a basic rate taxpayer is said to there get tax relief at the basic rate at source. Because what I am able to do is if I want my charity, as I've just said, to have £100, I've only got to give them £80. The basic rate tax that I had suffered and paid over to HMRC is given back by HMRC to my chosen charity. Good news. Right, so let's look at what we've got to say about this. Payments to charity under gift aid are treated as being paid net of our basic rate of tax. So my £80 paid to the charity was the net figure. For a basic rate taxpayer, tax relief at the basic rate is automatically obtained, as payments are made to the charity net of basic rate relief, being given at source, i.e., as we've just said, to give a charity £100, taxpayer need only make a gift aid payment of £80 there. The charity, as we've just said, will be able to claim back that basic rate tax of £20 from HMRC there and get their full £100. Therefore, the donation is not shown as a deduction in the calculation of taxable income. You do not see on that pro forma computation any deduction for gift aid payment, nor indeed, because it's exactly the same system that works here, on personal pension contributions. And they don't show on that income tax computation. They are not to be deducted. Instead, what we have is we've achieved basic rate relief at source by paying a net amount to the charity, or indeed, and probably with bigger numbers, into your personal pension scheme. And the basic rate tax on that amount of gross income that we'd received is paid over. So on my £80 donation to charity, the 20%, the £20 on a gross of £100 is paid across to the charity. If I put £8,000 into my personal pension scheme, that's out of a £10,000 gross income, where 20% basic rate tax has been deducted. My personal pension fund will be credited with the £8,000 that they get from me, and then a further £2,000 that comes back from HMRC. the 2,000 tax that they deducted from me on my income, they put back into my pension fund. So we get basic rate relief at source. A question may tell you what is the amount paid by the taxpayer. For example, as we've just said, £80. And therefore, you must establish what that gross figure is. Remember, in calculating adjusted net income, if you had to do that, then we needed the gross gift aid payment. We're also going to see that those gross gift aid or gross personal pension contributions are going to be needed for another purpose as well, that is going to directly impact in relation to higher rate and additional rate taxpayers on their tax liability. And the notes are coming up on there, as you can see in just a moment's time. So when you read a question, what figure of gift aid payment or personal pension contribution are they giving you? Are they telling you the amount paid? That's the net figure. That is 80% of the gross figure. The figure that we'll need to use for computational purposes will be the gross amount. So my £80 donation to charity is £100 gross. If they tell me in the question paid £80 into charity under the gift aid scheme, the gross is 100. What they sometimes do, made a payment under gift aid scheme to charity, £100 in brackets gross. They tell you that that is the gross figure. You don't have to gross it up at 100 over 80 for yourself. They give you the gross figure there. So read it carefully. Same with my personal pension contribution. They either tell me that I paid £8,000 into my personal pension scheme there, and that therefore is a net figure, and to get the gross, my 8,000 times 100 over 80, grossing up for the 20% basic rate tax, gives me my 10,000. Or the question tells you paid personal pension contributions of £10,000, in brackets next to it, gross. So we need to establish what that gross figure is. Now then, if you're only a basic rate taxpayer, there's nothing else to do. You've had your basic rate relief at source, as the saying goes there. There's nothing else to do. But if, as is more likely in many exam questions, you are at least a higher rate, if not an additional rate taxpayer, then you are able to gain your higher rate tax relief and, if necessary, your additional rate tax relief through the income tax computation. Now, how is this done? Right. For higher rate taxpayers, 40% tax relief, the higher rate, is given as follows. We've already got our basic rate relief, 20% at source. Again, I gave £80 to the charity got £100. I've got the basic rate at source. But if I'm a higher rate taxpayer, then I do get and deserve higher rate relief because I've suffered 40% tax on my £100 of income, not just £20 basic rate. So what happens? The other 20% is through the income tax computation. Now, it doesn't show, remember, we do not deduct these payments on the face of the computation. So how do we get that extra, that higher rate relief? Here we go. Obtained by extending the basic rate band. We know that the basic rate band limit is £34,500. If your taxable income goes above £34,500, then instead of paying tax at 20, you then move to paying tax at 40%, an extra 20%. So the way in which we now get our higher rate tax relief is by extending that basic rate band by, of course, and hence why we needed it, the gross donation, or in the case of personal pension contributions, the gross personal pension contributions. What does that do? It means that more income is taxed at 20% and less at 40%. We're getting that 20% saving. So, for example, if I have got a income figure, a taxable income figure of £40,000, then without reference to gift aid payments or to personal pension contributions, my 40,000, let's assume for the sake of argument it's all non-savings income, it would be a simple tax calculation. $34,500, the basic rate band limit, would be taxed at 20%. And the balance, the extra from 34,500 up to 40,000, an extra 5,500 would be at 40%. Well, imagine now that I had got a gross gift aid payment of, I'm going to be very generous now, a gross gift aid payment of £1,000. I paid 800, donated 800 to my favourite charities, and the 800 net is a £1,000 gross. So what do we now do before we start to do our tax calculation and compute our income tax liability? We extend the basic rate band by the gross donation. So what do? Instead of having a basic rate band limit of 34,500, it's extended by 1,000, so it goes up to 35,500. So instead of taxing 40,000, 34,500 at 20%, 5,500 at 40%, it will now instead read £35,500 taxed at 20% basic rate and just £4,500 taxed at 40%. So in that way, we've moved £1,000 of our taxable income out of the higher rate band back into the basic rate band, therefore achieving that differential saving of 20%. Something that would have been taxed at 40 is now taxed at 20% instead. Now again, I'm trying to explain to you here the effect of the system. All you have got to do is a very simple thing. You've got to pick up, you've got to identify in the question, there is a gift aid payment or there's a personal pension contribution. What do we then have to do? Identify the gross amount of that. Have they given me the gross figure or have they given me the amount paid? In which case, I must gross up the amount paid times 100 over 80 to give me the gross figure. Once I've got that gross figure, what do I do with it? If my taxpayer is a higher rate taxpayer, I extend the basic rate band limit of 34,500 by that gross figure. My example a moment ago, the £1,000 meant instead of 34,500 as the limit, 35,500 became the limit. As we'll see in a moment, if I were lucky enough, if only, to be an additional rate taxpayer, then the £140,000 higher rate band limit, where I move from 40% to 45%, it would be extended by exactly the same amount. So if I were an additional rate taxpayer and I'd made that gross gift aid payment of £1,000, instead of having for me, in my tax calculation, a basic rate band limit of 34,500, a higher rate band limit of 150, both those figures would be increased by £1,000. It would mean that for the higher rate band, I'm moving income out of higher rate back into basic rate, and for the higher rate band limit of 150, I'm moving income out of the 45% band back into the 40% band. That's the effect. So all I've got to do is establish the gross figures of either or both of those payments, gross gift aid, gross personal pension contribution, and extend the basic rate band limit and the higher rate band limit, if necessary, by those gross figures. Once done, then I proceed to do my normal tax calculation. Non-savings, basic rate, but now up to the extended basic rate band limit, to higher rate, to additional rate, after non-savings, savings income, and then dividend income there. So it's all the same calculations thereafter. You've simply got to revise, to restate, to extend the basic rate band, and here with additional rate, we extend, of course, that higher rate band limit of £150,000 by exactly the same figure. That's all you've got to do. Now, again, we see that in a lot of questions. It's an obvious area for testing because it makes that tax calculation that little bit more interesting. And again, it lends itself either to an objective testing question, Section A objective testing question, or indeed to part of the preparation and presentation of your income tax computation in Section C. So vital, therefore, that you get your head around this. And it is applicable, this same system, whether we're talking about gift aid payments to charity or whether we're talking about personal pension contributions. Now, I do stress there, personal pension contributions. In Chapter 10, and also indeed in Chapter 9, Chapter 10 deals with pension contributions. It's specifically deals with pensions. Chapter 9 deals with employment income. And if somebody is in employment, we'll discover in Chapters 9 and 10 that the employer may run what is referred to as an occupational pension scheme. And the employee and the employer, on behalf of the employee, may pay into that scheme there. So that's a different type of pension scheme, and the tax relief is achieved in a much different, in fact, a much simpler way. We are only talking here about personal pension contributions. Again, it's a mistake often made by students. They just think about pension contributions like they are one thing. No, they are not. The system here that we've just explained to you, I've just explained to you there, that is for personal pension contributions, not occupational pension scheme contributions. That we'll talk about in Chapter 9 on employment income, and about both of these schemes in more detail in Chapter 10. Okay, let's have a look therefore at some examples now. Example 13, we've got one source of income. Elliot has a trading profit of £49,000 and he paid £1,600 to charity under the gift aid system. So what do we know about that? Trading profit 49, that equals non-savings income. If we take £11,850 worth of personal allowance away from 49,000, then our figure of taxable income is going to be above 34,500. So we would be, without any other information, a higher rate taxpayer on at least a small part of our overall taxable income. But we've paid, note paid, £1,600 to charity under the gift aid system. Right, it doesn't say gross next to the 1,600. So we've got to get that gross figure by timesing it by 100 over 80, grossing it up for the basic rate of tax deduction at source. So 1,600 times 100 over 80 will be a gross figure of £2,000. So what does that mean? What you're going to do this, not I, in a moment's time. Set up your computation, obviously with one source of income here, non-savings. You don't need, but it'll be shown in the model answer, a non-savings column and a total column. If this was an objective testing question, you're just going to put in 49,000. You're going to deduct your full available personal allowance of 11,850. You're going to get your taxable income, one minus the other. And then instead of using a basic rate band limit of 34,500, it's going to be increased by 2,000. You'll add 2 to the 34,500, it'll be 36,500. That, of course, will then take income that might otherwise have been taxed at 40% and put it back into the 20% band. Do your calculations, get your tax liability. Job done. Okay, that's not a difficult exercise. No pressure, therefore, here, guys. I want you to have a go at that yourself. Check out the answer then to example 13 and then rejoin us. Okay, well, hopefully no problems there. We can see the answer to that example 13 in front of us now. Hopefully you've already reviewed through. As we knew, the only income we had was non-savings. It was trading income of 49. We've got a normal personal allowance of 11,850. Again, it's going to be relevant in a moment's time. I say we can see that we've got a full personal allowance of 11,850. The reason being we've got nowhere near the adjusted net income limit of £100,000 before we start to lose out, to reduce that personal allowance. Keep that thought in your mind for a moment's time there. So we've got our personal allowance and we've recomputed the taxable income as usual. But before we start to do our tax calculation, there's an important exercise, an important working to do. As we did together there, as we discussed, we start with the basic rate band limit, the normal 34.5, and we increase it by the gross amount of the gift aid payment. That's a further 2,000 up to 36.5. Therefore, the first 36,500 of this taxable income is to be taxed at 20%, the basic route. And that leaves only £650 there to be taxed at 40%. So all you've got to do, find your gross, find your gift aid payment or personal pension contribution, identify the gross amount of the gift aid payment or personal pension contribution, and then proceed to extend one, as was only required here, the basic rate band limit by that gross figure. But of course, if we go above 150,000, then we must also extend that higher rate band limit of £150,000 as well. And that's what we're going to see happening in terms of example 14. Example 14, we read, Thomas earned £160,000 in trading profits in 1819. So again, non-savings. In the tax year, he paid £6,400 to charity under the gift aid scheme. Again, doesn't say there gross next to the 6,400, so the amount paid is the net figure. So yet again, times 100 over 80, and that will come to a nice round £8,000 figure. What does that mean? It now means that both your basic rate band limit of 34,500 and your higher rate band limit of 150,000 are going to be extended by the gross amount of the gift aid payment. So we're going to be adding 8,000 to each of those figures. So when you come to do the tax calculation, as you will in a moment's time, then you're going to use the revised basic rate band limit and higher rate band limit that will be £8,000 bigger than the set given figures on your rates and allowances page. But there's another issue. £160,000 of net income. That net income is considerably greater than the adjusted net income limit of £100,000, whereby we would start to reduce the personal allowance. It is equally significantly greater than another number you should know in that context, 123,700. Because if your income, adjusted net income, goes above 123,700, then you've got no personal allowance left at all. There will be zero personal allowance to apply on your income tax computation. What is that adjusted net income? Now, it's not going to make any difference here, but what is it? It is your net income, 160, minus your gross gift aid and any gross personal pension contributions. So the 160 is reduced by the 8, that would equal 152. Now again, without doing those calculations, just looking at it in your head, 160 less 8 is still a whole lot more than 123,700. What does that mean? It means that there's no personal allowance. So your only income is non-savings 160. There is no personal allowance to deduct from it because adjusted net income has exceeded 123,700, let alone £100,000 there. So 160,000 is also the taxable income, but now what limits do we use? We do not use 34,500 and 150,000 respectively. We add to each of those basic and higher rate band limits £8,000. So with that in mind, I'd like you now to work through that particular example, check it out with the answer, and also before next time to have a little go at example 15 there as well. So you do 14, also little homework exercise, do example 15, and then we'll pick it up again together for the next part of our studies, where we have again issues that pertain to married couples in terms of their income tax computations, because they're not taxed as a married couple, they're taxed as individuals, husband and wife, civil partner, they're taxed individually. So it sets up a problem. That is, if they jointly own an asset from which income is derived, how are we going to split that income onto each of the spouses, each of the civil partners' own individual income tax computations? I bet you can hardly wait. We'll talk about that next time.